CCC is the cash conversion cycle. It's broken up into the average age of inventory and the ACP. If I add those two together, what do I get? Your operating cycle. Yeah, your OC. Okay, so the example we looked at last week was this one basically. Okay, obviously you've got the completed answers here. If I take the average age of inventory, which is how old the stock is on average, and I look at the receipts, i.e. the collections, okay, that gives me the operating cycle. Right, this is the actual cash conversion cycle, because do you agree, if you're able to secure favorable credit terms with your supplier, is that going to lengthen or shorten your cycle? If you can secure favorable credit terms and conditions, okay, all right. What would it do to the APP? What would be favorable terms from an APP point of view?
So we're talking from the creditor's point of
view? From our point of view, from the business.
So we want longer.
Exactly. Correct. Okay, so you would want longer, okay, periods in terms of the APP. And if you have longer periods, that'll be seen as being better for the business, which then shortens the cash conversion cycle. Okay, so the CCC would shorten should the APP be extended. Okay, so we want favorable credit terms to then shorten the cash conversion cycle, because now they're actually financing our stock, or they're financing part of the business for us then to operate. Okay, there's a note about aggressive versus conservative. Okay, what was this focusing on? Okay, permanent or seasonal funding, that was the key. Okay, so you had aggressive and conservative. Those are two different methods that you could implement in terms of meeting your requirements from a funding point of view. Right, and the reason for that is seasonal requirements can affect the business. Okay, so during certain times of the year, you might have a spike in terms of the need for cash flow. Okay, you might require more cash to do certain things. Okay, maybe to buy more stock, to finance certain projects, and that creates a seasonal spike, okay, in cash flow. Right, so if I'm aggressive, I'm going to raise capital when I need to raise it. Okay, so I'm not going to raise everything today. I'll do it when I have to do it. Okay, that's aggressive. Right, and the reason why that's aggressive is you're raising capital, or you're potentially raising capital in the future. So do you know what the stock's going, not stock, do you know what the rate is going to be in the future? No. Okay, and because of that volatility, right, or that uncertainty, that risk, that is considered more aggressive. Okay, conservative is, well, I know what the rates are today. So I'm going to take all the capital today, okay, and I'm going to leave it in a bank account. As and when I require it, I would then be able to access it. That's conservative. Okay, so we're funding the seasonal and the permanent. Okay.
Just to backtrack, so the
sure.
conservative you say is because you know what the rate is today and there's less risk involved.
Yeah, there's less risk involved because you're raising all the capital you need today, and you're going to be saving a portion of it in a money market account or a bank account or some short-term access account, okay, and the rest, okay, will be used on a day-to-day basis. Okay, so the surplus is saved in an account, and the balance is obviously used. Okay, right, and this is obviously long-term debt. Okay, long-term debt we know, okay, carries certain risk, but at least I know what the rate is today. Yes, those rates can fluctuate and change, but I've got sufficient funds on hand. Okay, also something else to consider. What happens later on in the life of the business, and the business isn't doing so well? Do you think they'll be able to access as much finance? No. Okay, so maybe today it might be better to raise capital because things might change. Okay, maybe the requirements become more difficult to meet and I can't raise capital when I need it. Okay, right, then we looked at the cycle. Obviously, cash is the focus. We know cash is going to be used to pay creditors. We know creditors can help us finance inventory. And we know inventory is part of the sales process because I need to buy stock to sell it, and your debtors will then owe you at a certain amount. Okay, so if I'm looking at the cash conversion cycle, CCC. Okay, this diagram actually summarizes it. CCC is what? APP, the AAI, and the ACP. Okay, there are 4 components, right, which make up your working capital. Right, working capital is broken up into current assets and current liabilities. Okay, my current assets, cash is a current asset. Okay, debtors is a current asset. Inventory is a current asset. Creditors is a current liability. Right, so those 4 components, current assets and liabilities, they make up your working capital. Okay, so the new content, okay, we're covering that today. Okay, study unit 5. Now we're looking at the inventory management. Okay, so we just spoke about the cash conversion cycle. Now we're honing into one of the components. Okay, we're trying to look at the inventory aspect of the cash conversion cycle, okay, or the working capital in general, okay, as a whole. All right, so when looking at inventory, we know inventory needs to be bought, okay, in order to sell stock, to make a profit, or to receive some sort of income or inflow that's going to help the business operate. Okay, so the learning outcomes here, you'll see EOQ is very important. Okay, you do need to know how to calculate economic order quantity, and you do need to understand why we need EOQ. Okay, what does that measure give us? Okay, you might have covered this in other modules. I think operations, they cover it as well, M&O and ecos. All right, so it comes up very often.
There was a funny question in the paper now that I just wrote with this. Is they asked the reverse of this question.
What do you mean the reverse?
So it was.
So you're looking for one of the components,
yeah,
or the variables.
So just completely.
Okay,
so
okay.
I'm used to just going
that way.
Yeah,
okay.
Just completely stuff.
Okay, so that was more a maths question than a theory question, because if they give you EOQ, let's say EOQ is 10, right, and you've got the root sign with the 2 times the demand and the order and the carrying costs, okay, you would then have to put in the variables. So maybe this is 5, maybe that is, I don't know, 20, and then you have to solve for this. Yeah, so you'd have to get rid of the root sign. So how do I get rid of a root sign? I'd have to square it, so I'd have to square this, and then I can do some mathematics. Okay, yeah, but we'll look at that. Have they posted 2016 up yet? Okay, could you email that to me, and then we've got that exam, and we'll do that one as the first exam. Okay, we'll go back in time. Factoring question. Okay, so sure.
25 marks.
Wow.
That was what.
Was it a theory question, or was there calculations?
It was theory and calculation.
Yeah,
so
theory and calcs.
So you had to do theory on factoring and pledging, the difference between the two.
Okay.
Examples, and then you had to do a 20-mark calculation.
Okay, that was probably if you had to change your credit policy or lengthen or shorten your.
Going to go into pledging or factoring.
Yes.
You had to work at what the costs were going to be.
Okay. Okay. Sure.
I wrote the biggest bunch of BS
okay.
I've ever written in my whole life.
Sure.
Yeah.
But what did you eventually get for the module?
I think I got 37%.
Oh, okay, yeah. So it was a fail, yeah.
From a 70-mark paper to drop 25 marks.
Yeah, it's a lot. Yeah, 20 out of 70 is like what?
Yeah,
about 28%, 30%.
So 25 out of 70, that's about right. So they're really
35%, yeah.
So you're room for error.
Yes.
It's so small.
Sure, yeah. Okay. Yeah. All right. So inventory management. What is inventory? It's a current asset because we're looking at components for net working capital. Okay. So we know inventory is a current asset. If it's a current asset, it's a short-term asset, and it's used for operations. Okay. So companies need inventory to operate. Okay. Inventory can be a whole host of different things. You can get work in progress. That's inventory. You can get raw material. That's inventory. Okay, and obviously all of that will be used to do what? Create the finished product. Okay, so inventory can take the form of many different items. Okay, you obviously look at like costing, and that's management accounting. ABC, traditional, and those types of things. Okay, that's more the management accounting where you're looking at managing this. Okay, maybe the operations in terms of reducing wastage, optimizing processes, and so on. Okay, but we're just focusing on inventory as what? A current asset, and we're considering the cash flow. So is inventory cash flow? It is. A change in inventory is cash flow. Okay, so a change in inventory, okay, would be considered cash flow. Okay, change is that mathematical symbol. Okay, all right. So what are some of the advantages and disadvantages of inventory management? Why do we need to manage stock then? Good. Okay, so advantages could be you don't want to hold too much stock. It's costly to hold too much stock. Okay, you don't want stock that's going to become obsolete. That's a disadvantage. Okay, obviously you don't want to commit too much cash. Okay, because remember you need to finance that stock. So you're either buying it with your own cash or you're using credit to do it. Okay, that could be a disadvantage, holding too much stock. Okay, something else that you could consider is what happens to stock? It can get stolen. Okay, it can get lost or damaged. Okay, so it's a risk. Right, there are obviously risks associated with holding too much inventory. Okay, so we need to manage it as best as possible. Alright, so what do we need to do as the financial manager? Well, as the financial manager, you could employ someone who would be totally, okay, let's say overviewing or controlling and monitoring all the inventory, okay, as oversight for that particular function. Right, so the financial manager, the manufacturing manager, the purchasing manager. Are all three of these individuals going to be involved with stock in some sort of capacity? Yes. Okay, so inventory, okay, is actually a very, very important area of business because we said sales is everything, okay, in terms of a company. Right, a company needs to target a certain amount of sales, which is the budget. Okay, in order to achieve the budget, you need to have stock on hand. Okay, what about meeting certain orders? Right, that's a commitment. Okay, if you don't have sufficient inventory on hand, you're not going to meet the order, you might lose out on the sale. Okay, or what happens if you're looking at manufacturing stock and there's a big delay? There's going to be wastage. Okay, there's going to be a delay in the process. Right, so the role of the inventory manager is to actually manage the stock and to keep things operating, okay, to make sure your operations are as effective as possible. Okay, we obviously want the cash conversion cycle, okay, to convert cash quickly, easily, and without too much delay. Okay, that's the main objective. All right, so there are some common techniques that we need to look at here. Okay, fortunately, you're not going to see things like the ABC system. Okay, ABC is basically just ranking. That's all it is. If you want to just keep it simple. Okay, it's just ranking your stock. Okay, ABC, from most important to least important. Okay, EOQ is something that you are going to have to do. Okay, so that's an NB in this particular module. Right, you are going to have to do a calculation for EOQ. Okay, and what does EOQ do? There's the note. It minimizes the total cost. Okay, the total cost of holding and ordering stock. Okay, we'll look at this just now on a separate slide. Okay, you've probably heard of just in time. What is just in time? Correct. Okay, so what does just in time do? Okay, but in terms of cash flow, it eliminates the holding costs and it eliminates the, well, the ordering cost would be, yeah, the ordering cost would be part of what? The purchase. Okay, yeah, the ordering cost is part of the purchase. The holding cost is part of the stock at the business premise. Okay, so just in time eliminates the holding costs. Okay, ordering costs, you obviously need a reliable supplier. Okay, you can't implement just in time where you have unreliable suppliers. Okay, because now someone doesn't come with your stock or the raw material and now you're stuck with the problem. Okay, your whole production line is going to be halted because the supplier was unreliable. Okay.
Is it commonly used?
Just in time, in more how can I say, in more reliable economies. Yeah, in South Africa, you're not gonna be able to implement just in time. Okay, because delivery, just the way in terms of doing business in certain countries just doesn't lend itself to being using that. Yeah. Okay, but just in time was created in Japan. Okay, all right. So there it works. Here it wouldn't. Okay, all right. So it all depends. I don't know if you guys are watching the Olympics. Those athletes are like they dedicate their lives to that like discipline, and it's remarkable to see. I was watching the BMX. I'm sure when you were a kid, you like used to go with the BMX and stuff. And like you ramp and jump around all these like the pavements and stuff, and like when you're young, and I was watching like this guys are unbelievable, and like you can see how committed they are to their craft, like that's the pinnacle of that area. So if you're wanting to be a sports person, right, as far as you can go is Olympic gold. Okay, that's everything. Yeah. So it works for some people, it doesn't work for others. The main thing here is obviously you need to have a reliable supplier. That's the biggest thing. Okay, not to say you don't get reliable suppliers in South Africa, you do, but it's difficult to find. All right. I think you do, but so if you might be able to implement just in time for certain, let's say, suppliers. All right, so maybe certain suppliers that are reliable, you could maybe say, well, I'm going to then not commit to holding stock for that supplier's product, but I can hold stock for others. Okay. Yeah, strikes. Can you imagine a strike affecting delivery?
And strikes come about in the blue one minute striking and there goes.
Yeah, so it might not be because companies aren't, let's say, reliable. It could be other factors, external factors, exactly.
Like fuel, blah, blah, blah.
Yeah, fuel shortages, strikes, riots. Yeah, that could also lend itself to something like that. Okay. Right, computerized systems, everything today is controlled via technology. Okay, and international considerations. In today's world, the world's a lot smaller than it has ever been, purely because you can do business from anywhere. Okay, and obviously inventory is now something that you can obviously import and export. Okay, all right. So here's the calculation that you need to do. Okay, EOQ. Right, what does EOQ do? It analyzes. Okay, well, what does it stand for? Economic order quantity. Do you agree? Okay, so what if something is economic? What does that mean?
It's economical. It makes sense. Makes business sense.
Okay, yeah. So it's almost, let's say, cost effective. All right. So the economic order quantity is looking at the most cost effective quantity that you should be ordering. Okay, because if I order stock, I'm going to hold more of it. It's going to increase my carrying costs. Okay, but if I order more stock, I reduce my order costs because buying bulk is cheaper than buying individual. Okay, so what will be included in the ordering costs? So give me some examples. Transport, perhaps? Sorry? Packaging?
Urgency. Urgency.
Okay.
Special delivery.
Yes, okay, so think about the process, the behind the scenes, okay, the back office. Okay, someone is going to have to do what? Check the stock, count the stock, process the stock, receive the stock. Okay, and all of that would be part of the ordering costs. Okay, the cost of placing an order. What will be included in the holding costs? Like? Okay, good. So the physical space. What else? Besides the space. Okay, the security to look after it. Okay, the insurance. Good. Okay, even things like obsolescence. Okay, that would be part of your holding costs because think about it. If let's say you're a yogurt manufacturer. Okay, and the yogurt goes off. Who pays for that cost?
Sure.
The firm, the dairy manufacturer, right? Okay, so the holding cost could also be the wastage. Okay, so any wastage that takes place is a holding cost, right? If I'm holding yogurt or milk or anything dairy related, okay, anything that goes off is a cost. The company needs to cover that somehow, and they cover that through their holding costs. So storage costs, insurance, cost of deterioration, obsolescence, even theft. You can even put that here as well. Theft would also be part of your holding costs. Right, so a certain amount of your stock may get stolen. Okay, be it from the public or customers, or be it from employees. Okay, it's a possible cost that you would have to incur. Okay, so EOQ is looking at determining the optimal order size. Okay, the smallest or the best. Okay, in terms of number of goods that I should purchase, that's going to reduce and minimize all the costs, not only carrying but also holding. Right, so here's the theory. Right, I've given you a table of values just to show what happens to each of the costs. All right, so quantities here. Okay, I'm obviously increasing quantity. Okay, if I start with 1 unit, okay, the ordering cost for 1 unit would be higher than the holding cost for 1 unit. Okay, if I buy 1 unit of 1 unit, okay, that unit can be stored anywhere. It can be stored in the office. It can be stored maybe in the storeroom. It could be stored anywhere potentially. Okay, it could even be stored on the vehicle. Okay, but what happens if I increase my number of units? Okay, ordering cost starts to decrease. Okay, holding costs start to increase. Okay, and you can see the one, okay, is in that direction, the others in that direction. So what is the relationship? Is it linear? Ordering? Is it linear? Does it always have to be a linear relationship? No. Is it an inverse or a direct relationship? No, indirect. Why? When your quantity increases, your ordering costs decrease. Okay, so low here, high there. Okay, high here, low there. So the relationship would be inverse for ordering. Right, for holding, direct relationship. Okay, so you'll see the one is decreasing, the one is increasing. It's like supply and demand, right? The one's going this direction, the one's going that direction. At some point in time, they're going to cross. Okay, and that cross is the EOQ. That's what you're actually working out. Okay, so this is basically mathematics. You're just taking y equals mx plus c, or you're taking non-linear functions and you're plotting them on a graph. Right, and that graph will give you some point of intersection, which gives you what? The EOQ. Okay, so on your next slide, right, I've given you a note there about the graph. Cost and quantity. Okay, what are we trying to do as a business? We're trying to reduce the total cost as much as possible. Okay, so if you had to find EOQ, you'd be looking at the holding cost, and you'd be looking at the ordering cost, and you'd be looking at where those two intersect. That's what you're looking at. Okay, let's add an extra graph to this particular line. Okay, where would the total cost function be? Where would the total cost function be, guys? Total cost. How would you plot total cost on this diagram? Horizontal line, no? Yes. How would you plot total cost on this line, on the system? Yes. So ordering plus holding would give you what? A graph that would look like what? That would look like, no, like this. Okay. That would be your total cost function. Okay, the reason for that is at some point in time there, you've minimized your total cost. Okay, your ordering plus your holding will give you a total. Okay, because here, okay, let's say that point was 10. Okay, that means when holding costs are 10, ordering costs are 10. So the minimum total cost would be 20, right? Okay, if I take it one step back, I'm going to have maybe ordering cost of 12, okay, and holding costs of 9. That gives me 21. So I'm sitting over there. Okay, and the same thing here, maybe 21. Right, 22. Okay, so 23. Right, so the theory, the mathematics behind it would be that. Okay, that line of intersection, where the tangent touches that curve, that would be the minimum. Okay, in terms of EOQ. Okay, so EOQ is where your total costs have been minimized. Okay. Right, so total cost is always the sum of the two. It's the ordering plus the holding. Okay, if you add the two, you'll get the total. Right, and that would be over here, okay, at the top. Right, because each of those lines represent an individual cost. Okay. Is that alright? Okay. There's the formula. Okay, I've tried to keep it simple. I know some textbooks use mathematical variables, okay, to highlight what they're actually trying to, let's say, work out. I've just tried to put it in simple English terms. Okay, EOQ is 2 times the units, and it's the units that are demanded, okay, or purchased or bought, right? That's required for the business to operate. Okay, the ordering is the cost placed for each order, okay, and the carrying would be the cost for each item. Okay, it's just something to remember here. If ordering cost is per unit, what must carrying cost be? Per unit. Good. Okay, so just be careful with how they've given you the question. Okay, have they given you per unit cost or have they given you total? It doesn't matter which you use. You could use total cost, so total order cost. Then you would have to use total carrying cost. So if it's totals, you use totals. If it's per unit, you use per unit. Okay, if it's a total for the month, let's say you're working out EOQ for the month. Right, then you need to look at the ordering cost for the month and the carrying cost for the month. Okay, month with month, total with total, per unit with unit. Just keep them the same. Okay, right, so here's an example here at the bottom. Inventory cost 2,000. Company X uses 1,005 during the year. The order cost per unit, okay, per order actually, is 200, and the carrying cost per unit per year is 300. What would the EOQ be? Yes? Yes, yeah, because this would be the order that I've placed for those goods. Okay. Is that what we get? Yeah, 4472 is correct. Yes, you would. Okay, so with EOQ, you always round up. Why? I can't buy a fraction of a product. You either buy the entire product or you don't. Okay, if you go with 44 units, okay, that's too little. So we'll have to round it up to 45 units. Yeah, 45 would be the actual answer here. Okay, so you would always round up, irrespective of the decimal. The decimal could be 44,0001. Okay, you would still round it up. Okay, in that example, all right, you're looking at total costs. Okay. All right, next one, guys. Example 2. Also straightforward. $2,000. Do we agree? No. Total order costs. Okay, yes, divided by your units. Okay, because this was the total order cost and the carrying cost per unit was 30. Okay, remember we don't know what these units are. We don't know what the cost price is. That's not a consideration. Okay, so it doesn't matter how big or how expensive this project or this item is. All I'm looking at here is the cost of storage compared to the cost of ordering it. Okay, so notice here, there's no mention about what product this is. Okay, this could have been huge items of equipment. This could have been small items. It doesn't matter. Okay, we're just looking at costs. We're looking at ordering and we're looking at carrying. Irrespective of what type of item we've got here, okay, remember that's a separate consideration. Okay, so we're not looking at how expensive or how cheap this item is. We're just looking at, if I had to buy the item and hold it, okay, what would the cost be and how would I minimize the actual costs? Okay, so just be careful with this one. Okay, if you use total, total with total, per unit with per unit. I've got two separate workings. You could have done it either way. You still would have gotten the same answer. Yeah, 37 units if we round up, correct. Okay. But you do get more sophisticated EOQ models where they actually take time value of money into account. Okay, but that's not something that we need to look at. Okay. Is that alright? Okay, you guys got the answer? 37 units for this one. Okay, what about the next one? How about this one? Example 3. What is the EOQ? $31.62, do we agree? Okay, so the working here, no, I had 252. Okay, total order cost for the year and total carrying costs. Oh, this was per unit. Total order cost per unit. Okay, so that was 4,000 times 4,000 times 1,000. Okay, the wrong cost at the top. Okay, yeah, 252. Okay, so the total order cost per unit was that 1,000 Rand a unit. Okay, and the carrying costs 500,000. What type of item could this have been? The order cost was quite high, that's per unit, and the carrying costs are quite substantial as well. Bigger items of stock. Okay, large items. Okay, guys, happy with that one? Alright. Here's a note about reorder point. Okay, so what does EOQ give you? EOQ gives you what? The best order to place. Okay, the order. So how much must I actually buy? Okay, so EOQ tells you how much to buy. How much? Okay, that's what EOQ is answering. Okay, the question EOQ is answering for us is how much stock do I buy? Right, how much stock would I buy? I would buy stock at the EOQ. Okay, reorder point is looking at the when do I buy. Okay, so now you know how much to buy. Now you need to know when do I buy the goods. Okay, reorder point gives you that information. Okay, and that's how we better manage inventory. Okay, so we don't hold too much of it. Okay, we try to minimize the ordering and holding costs as much as possible. Okay, because if you're reducing costs, what is that going to do for the company? It's going to maximize value, yeah, or wealth for shareholders. Okay, so how do I calculate reorder point? It's the lead time times the usage. Okay, again, it could be days with days, months with months, years with years. Okay, so reorder point is the lead time times the usage. Okay, so when would this company place an order? Well, the firm knows that it takes 5 days to place and receive an order. If 100 units are used per day, then what would the reorder point be? 5 times 100, exactly. Okay. But again, you're assuming that your supplier is going to deliver in 5 days. Okay. What happens if there's safety stock, or if you want to keep safety stock? What would that do to reorder points? What would safety stock do to your reorder point? It would increase the reorder point. Okay, because now you would reorder sooner rather than later. Okay, so if I had to hold safety stock, let's say I wanted an extra 100 units as additional safety stock, just in case we have a strike, we have fuel shortages and so on. Okay, so you would then add 100, okay, which would then make your reorder point 600, okay, which lengthens the time that it would take, okay, for the firm to deliver. So now we've got 6 days. Okay, so we've got 1 day in terms of safety, right, from having received goods from the supplier.
So is it 500 units per day?
Yes, 500 units represents 5 days worth of stock that you would have to hold.
Because of the 100 a day.
Because of the 100 per day, yeah. We're just using an average. Obviously, maybe some days you might use more, some days you might use less. Okay, then that creates a bit of a model that you might have to project. Okay, I think in operations, M&O, you guys probably did that in more detail. Like a, what do they call it? MRP. Yeah, material requirements planning and all of that. Okay, is that all right? Okay, so there's the note. When inventory reaches 500, what do? I place an order. And how much do I buy? I buy at the EOQ amount. Okay, because EOQ minimizes the cost. Because I don't just buy stock for the sake of buying stock. I buy the correct amount of stock. Okay, and the correct amount of stock would be the EOQ. Okay, so that's the theory. That's how we would implement it. Okay, is that alright? Not so bad, hey? Okay, then just some theory here toward the end. Just in time, we spoke about it earlier. What is just in time? We mentioned it. Okay, it's reducing carrying costs, okay, to zero, hopefully. Okay, that's what you're trying to do. You're trying to reduce the carrying costs as much as possible. Okay, because think about it. For most companies, which is more of a control, let's say, variable? Can I control my carrying costs, or can I control my order costs? Okay, well, you can negotiate, but if the consumer is going to say, well, not the consumer, if the supplier is going to say, well, this is the price of the order, and you can't really do much with that. Okay, but do you agree with carrying, you can do more in that respect? Okay, because think about insurance. Cheap or expensive? Well, if I'm carrying lots of stock, it's going to be pretty expensive. Okay, because now I'm trying to insure each and every one of those items. Okay, and that can be very costly. Right, so to avoid massive premiums in terms of insurance, okay, or even massive risk, think about holding too much stock. That might be a fire hazard. What happens if those materials are chemicals? Okay, that's even a bigger risk, okay, versus if this was, let's say, food. Okay, or, okay, maybe food not the best example. Chemicals would be more dangerous. Let's say if it was bricks. Okay, if you were storing bricks, right, those bricks aren't really going to be damaged in a fire, okay, or something like that. But chemicals, I mean, your whole factory could blow up. Okay, so insurance for a chemical plant would be a lot more expensive than a premium, let's say, for a bricks supplier, okay, or that type of business. Okay, so we just need to look at different types of industries. Okay, there's the note. We spoke about it, minimizing inventory management. Okay, I don't have to hold so much stock. I don't want to hold so much stock, because if I hold too much stock, there's even obsolescence. Okay, you don't want obsolescence. Sure. Okay, obsolescence. Is that right? I think so. No. Obsolescence. I had it on a previous slide. Sorry, the spelling's not so great offhand. Sure. Obsolescence. How do we spell obsolescence? Obsolescence. Yes, obsolescence. Okay, so S-O. Okay, you can see this is not working well. Okay, obsolescence. No, I want to know how to spell it. S-O-L-E-S-E-N-C-E. Obsolescence. Yeah, sure. Okay, yeah. Tricky one. Spelling bee. Okay. All right. Manufacturing efficiency also. Okay, you want to try keep the manufacturing process as efficient as possible. Okay, and just in time helps to do that as well. Okay, and then on the last slide, you've got a note here about the computerized systems. We saw it earlier. Okay, companies obviously have sophisticated systems. Okay, MRP, MRP2, ERP to help manage stock, to help plan in terms of processes. Okay, to make processing more efficient. Okay, to control and manage those resources. We know resources are limited. Okay, so we need to try and manage them as best as we can to try reduce wastage and to try and make a more efficient process. Okay, international import and export, we spoke about that. It does carry added complexity, okay, and complications. Right, and even costs as well. Okay, think about importing and exporting. The cost associated with that would be more as well. Okay.